how in the world do you determine whether or not you stay or become an S Corp ESOP or a C Corp ESOP, and how does that work? Welcome back, everyone, to the Journey to an ESOP and Beyond podcast, where we seek to make all things related to employee stock ownership plans both accessible and understandable. I'm your co-host today, Jason Miller.
And I'm Makenzie Wirth.
And to be quite frank, we had no idea what to talk about today. Mackenzie's chuckling because we were sitting around thinking, what's our topic going to be? And that led to many of you and many of our clients often asking us, like, hey, is there really enough content for you to be putting out an ESOP podcast every week? Like, what is there to talk about? We kind of laugh it off until we find ourselves in a scenario like today, where it's like, there's a lot that's happened in just the past week or the past month or the past year. And we're neck deep or maybe even in over our heads related to positive news for ESOPs on the legislative front, on, I guess, the tailwinds to employee ownership and the level of notoriety is the wrong term. I just can't think of it this morning. Not enough coffee. That employee ownership is getting more broadly. But then we were saying, hey, what are some of the questions that we are getting that are probably the most fun for us to explore? At least that's the way I thought about it. Makenzie, you can speak for yourself on what it was. So today we're going to cover one of the major decision points for sellers examining an ESOP exit. And that is, how in the world do you determine whether or not you stay or become an S Corp ESOP or a C Corp ESOP, and how does that work? What goes into that decision? What do you think about that, Makenzie?
I like it. And I do think the technical topics are more fun to me, in my opinion. So I would agree with that. I also think even if we've had previous episodes where we may have touched on a similar topic, the conversation never goes exactly the same. And you can always go down different paths or different rabbit holes, so to speak. So um, one episode on the same topic may not look exactly the same. And you may hear different perspectives as well. So I'm excited for this one because I'm the CPA, but I'm putting Jason in a hot seat today. So
These are often the most fun ones for me to sit around and answer questions. So let's get at it. What do you got for me?
yeah. All right. So I guess I'll technically be playing the role of the business owner or clients that have these certain questions when the topic comes up. We may have a client that is an existing S Corp or an existing C Corp, and they don't even realize that this is necessarily a decision that needs to be made or could be made to switch to a C Corp or switch uh, to an S Corp for purposes of the transaction. So maybe before we get into the weeds of the ESOP implications, could you give our listeners just a quick refresh on the high level difference between an S Corp and a C Corp?
Sure. So the IRS is lovely. I'll say that on camera. All right. So every corporation files an 1120, and that's the corporate return. And a corporation can elect this S election that creates instead of the corporation itself being a taxable entity, it creates a pass-through to the owners. So that's the difference between a corporation, what we call a C Corp, and an S Corp. So you elected for the tax treatment or the tax liability to fall to the shareholders in the S election and not get taxed at the company level. I think most folks will go and research, like, what are the advantages and disadvantages of a C Corp versus an S Corp. And inevitably, the first thing is going to be double taxation. That sounds awful. What that means is that profits at the company level and net income at the company level in a C Corp is taxed. A corporation has its own tax rates, depending on size. And then if the owners take dividends, then the owners then get taxed on their personal income tax, their 1040, with their own tax rates on those dividends that they take from the profits of their company. So is it double taxed? That's the way that it is described. Two sets of taxes are being paid. Nobody likes paying taxes when they don't have to. I think that's a common theme for what we go through. And then in the S Corp, or with the S election, what happens is the IRS looks at the corporation and says, "Oh, you've taken this election. We're not going to tax the company, but all of the net income and all the tax liability falls on the individual shareholders of that company at their own personal tax rates, which are higher than the corporate tax rates. But is it higher than both of them being taxed? It depends. My favorite answer.
It always depends.
That's
That
right.
was a great overview. And I think one of the stereotypes of ESOPs or things that we often hear is kind of, oh, tax-free, tax-free. And one of the big important distinctions is it depends on whether you are an S Corp or a C Corp, and the tax implications depend based on that. Um, which I may be now answering the question I was about to ask you, but why does this become such a critical decision in the ESOP transaction? And does
Yeah.
one structure automatically produce a better outcome?
Ooh, I can answer that one really easy with a short answer. No, one does not automatically produce a better outcome. Um, every one of you that's listening, that's considering an ESOP transaction, you have your own reasons and you have your own objectives and you have your own goals personally and for the company and for your employees. And that's why you're looking at this as an option. And uh, just like when you would do research related to C Corps versus S Corps, and the first thing that comes up for C Corps is the double taxation, that tax freedom that Makenzie mentioned is what's going to attract people to ESOPs. Like, oh, there's tax advantages of selling your company's stock to an ESOP, but they're not the same. And so only broadly, only corporations, S Corp or C Corp, can become ESOPs. And with that, that where it gets taxed matters. So again, the IRS, being a lovely organization, is looking for the best ways through its taxation of ownership of transactions and of types to incentivize certain behaviors. Let's put it that way. So transitioning your company and its future profits to something that benefits your employees in an ESOP transaction is something that the IRS and Congress have supported for over 50 years. And how do we make this make more sense and do more of these things so that wealth starts generating in a retirement benefit for employees in a tax advantage way? Who do we get to incent? So that who question is what separates C and S and one from the other, and why neither is the same, and why each one might be better for an individual. So which one would you like me to start with first?
Yeah, let's start with S Corps and let me know your thoughts here, but maybe it makes sense to do the company tax implications under an S Corp and a C Corp, and then separately discuss the seller tax implications under an S Corp and a C Corp.
I think that would be great. One note that I'll make is you as owners don't often think about your ownership structure as something that can change.
Mm-hmm.
And as a corporation, again, you probably had advice from your CPA or your lawyer or both at some point throughout the existence of your company that said, you should be an S corp, or you should stay a C corp for whatever reason. And those are good reasons. You're going to have your individual reasons. Every company is different. So that's the first thing is like, well, how in the world, if I'm an S corp, can I become a C corp? Well, you can. We'll talk about that. So let's. Sorry for deviating there, Makenzie. But now let's go to, you said the company implications of C or S, right?
Right. We can
Okay,
start with, you can pick which one.
great. So let's do S. Let's do S corp because it's more fun.
Yeah.
So if you sell 100% of your company to an ESOP, and it is an S corp ESOP, the trust that buys your shares is a tax exempt entity. Let me say that again, tax exempt entity. So your company stays the same. We're going to say it's ABC Manufacturing Company. ABC Manufacturing Company historically has passed its tax liability onto you individually, owner, seller, shareholder, however we want to call you today. And then you have had to pay your personal tax rates, like we said earlier, on that ownership privilege. So now the ownership is passed from you to the employee stock ownership trust, which is tax exempt. So all of the net income falls through the corporation, the S corporation, and lands the tax responsibility or liability is on the trust, and the trust is tax exempt. So there are no federal income taxes that are due, and most state income taxes are also exempt or the trust is exempt from responsibility or liability for state income taxes as well. So zero tax.
Who doesn't like that? And one thing I'll add too is that's in the context, well, we know that you don't have to sell 100% of your stock to the ESOP trust. So in a situation where a selling shareholder only wants to sell a portion, we'll call it 30%, then whatever percentage the ESOP trust owns is what is tax exempt. So 30% in that case would be tax exempt. However, the 70% owner is still liable for that income tax.
Why'd you choose 30%, Makenzie?
It is typically the magic number with partial ESOPs that we see most often. If selling shareholders want to maintain control, then they need to maintain at least 51%. So I guess in that case, the most the ESOP can own is 49%. However, we often see 30%. But however, as I'm speaking, I think you are referring to the C Corp aspect, which do we want to switch to that?
Let's do that. We can always bounce back and forth. We normally do. If I miss something,
Yeah.
it'll come to mind. I'll spit it out, and then our listeners will suffer for it. So on the C corp side, you're like, well, I am an S corp. What do I do? And it is my status as a pass through, or the company as a pass through entity passing through the tax responsibility to me individually, is that immutable? And the answer is no. You can revoke your S election, and that means that you return to a C corp, and then the company picks back up its responsibility for paying tax at the company level. You're like, why would we ever do that? Because then we're back to double taxation and these other rates and et cetera, et cetera, et cetera. So the IRS and Congress also incent sellers to under C corp transactions, but differently. And it's, yes, the company is going to be responsible for paying tax at the company level at corporate tax rates in a C corp, but you, seller, if you sell at least 30% of the outstanding shares to the ESOP, you may qualify to defer your capital gain on the sale of that stock. And that's called a 1042 exchange. So you have to sell at least 30%. So it makes sense with our 30% number from earlier. And then the tax advantage isn't at the company level. The tax advantage is on the personal level for you as a seller. And that exchange is an exchange of basis in the stock of your company. And this is where everything starts to come together and go, oh, okay, well, that's great. What if I have a lot of basis? Then that's probably not a great advantage. It's like, well, what happens if we distribute that basis ahead of time? And then now you have no basis, and then now we have the capital gain. And then how do we do that with money and loans? And we go round and round on all of the factors that create the structure of your particular ESOP transaction, which is why this is a really fun technical topic for Makenzie.
Um, how would you describe the type of owners that benefit the most from a 1042 election?
Um, so we keep alluding to this every time it comes up. We're going to have to do just a 1042 episode and go
Mhm.
through. So listeners, we'll do that in the next couple of weeks. Put the stake in the ground like that. That's what we'll cover. So you're exchanging your basis in your stock for what's called qualified replacement property. The IRS says, hey, seller, if you do this to an ESOP, we think it's a great thing. We support employee ownership and all the magic benefits that happen related to that and support your transaction. And you get to, if you have zero basis in your stock, again, 90% doesn't matter. So you're taking your basis in your stock and they're saying you have to purchase other stock bonds, financial instruments of US companies of an equivalent amount. So I have to buy, if I sell my company for $50 million, then I have to buy $50 million of stocks, bonds, and floating rate notes, some combination of that. And what's happening is I have $50 million worth of ABC Manufacturing Company with zero basis. And so I'm going to exchange that basis into this $50 million of other things with all the strategy that we'll talk through in another episode. But because it's an exchange, IRS considers it an exchange. It's not a transaction from a taxable perspective. And so until that qualified replacement property sells, then you don't recognize the capital gain. So if we just say capital gains are 20% at the federal level on a $50 million sale, if you got everything up front, you owe $10 million to the federal government. They're super happy. And then you get to keep 40. And utilizing a 1042 exchange, you have the ability to defer that $10 million capital gain liability, potentially indefinitely. And then with stocks, bonds, and floating rate notes, your heirs, upon your demise, will receive a step up in basis, right? Because it's an exchange of basis. If you have zero basis, when you pass away, the basis becomes 100 at the time of your death. And that eliminates or erases the capital gain if there was no sale of that qualified replacement property. So for you, your heirs, your estate planning, and just in general, trying to maximize the advantages that the IRS has given us related to an ESOP transaction. That's how the mechanics broadly work. Now, who's that good for? Like if I owned an ABC Manufacturing Company and I'm 45 years old, I don't want to die anytime soon. I don't think anyone wants to die anytime soon, no matter how old they are. But what if I can never sell the qualified replacement property without triggering the gain? The younger that you are and the structure of that transaction on the 1042 side that does include personal leverage, you may not want to live with that for another 45 years. So age should have some consideration, but it's not the only consideration. One of the things that we often mention to clients is the complexity of the QRP acquisition strategy for them, and every individual is different. Maybe a complexity that they do not want to carry into their later years on their personal balance sheet. And so that's a consideration. Mm-hmm. High tax states, such as California and Illinois and New York have their own kind of double-digit capital gains rates on top of the federal, and so it becomes much more attractive since those follow suit with the deferral to do the math and figure out like, ooh, if we live here, like it might make a whole lot more sense for us to allow a company to be taxed, and then we pick up the advantage on the sale as sellers, because we're going to have to pay significantly more to our particular state.
Yeah. So our listeners can probably gauge already that there's many considerations and it's not just a simple answer, and it is not a consistent answer for each company or each selling shareholder. So under a C Corp, it's obvious that yes, the company is still paying taxes and the seller could have significant tax advantages in that scenario. In an S Corp, the company has the tax advantage, but it doesn't necessarily mean from, I guess, from a tax perspective, yes, the seller in an S Corp situation does not have the same tax advantages in the C Corp scenario. However, the benefit of the company not paying taxes can influence or impact the seller in a positive way. So let's maybe touch on that. And how does that play out?
Yeah, so now we need to kind of wipe the slate clean, because the transaction looks different for the C Corp than it does for the S Corp. And you're right. So let's imagine 100% sale to an S Corp ESOP so that the IRS no longer gets an income tax from the entity. But you, as an individual, don't have the same ability to defer your capital gain as cleanly with the 1042. I'm going to say not yet, and we'll get back to that in a moment because I've mentioned positive legislation earlier in the episode. So if you are selling as to an S corp or remain an S corp, the IRS does allow you to wait to pay what you owe them in your capital gain. So ABC Manufacturing Company sells for $50 million. You are entitled to consideration in the same amount, 50 million, that gets negotiated through the process. But you're unlikely to get all 50 million up front. I can pretty cleanly say that it is less likely for you to get all of it than it is for you not to carry back paper as a seller note. Some folks consider just doing seller notes. Some consider utilizing bank financing or some other private credit funds to help kind of bridge the gap with mezzanine financing. There are ways to get you more liquidity at closing. So the way the IRS looks at that is, seller, when you receive principal on your $50 million of consideration, however you get it, whenever you get it, you're going to owe your 20% in capital gains. But we're going to allow you, if you take back paper as a seller note under what's called 453A, it's the installment sale method, which means that you don't have to pay on the principal that you haven't received yet. But when you get it, that's when you pay us. And if it is over a certain threshold, then we are going to charge you for the privilege of making us wait to get the capital gain that we are due. And that's commonly referred to as a sting tax, 453A. And so there are certain exemptions and thresholds and whatnot that play into that we go through with clients. But basically, you're making the IRS wait for something that it is licking its chops for, and their appetite is getting bigger every year until they get paid or until you get paid. So you get to pay for the privilege of waiting.
So not the same as completely deferring your capital gains, but it is better than having to pay all of the capital gains up front. And then in regards to the fact that the S Corp is, we'll assume 100% ESOP owned, it pays zero federal income tax. How does that additional cash flow typically get used?
Yeah, and Listeners, this is the part where I just get to ask you the question is what would you do with an extra 30 to 40% cash flow every year at your company level? So if you had an extra 40 cents on every dollar that you earn in profit, just sitting around, what would you do with it? And the most common answer, to get to your question more directly, Makenzie, is now that we have a significant amount of debt related to the ESOP transaction that is unproductive capital, right? Retiring that debt quickly is the most common application of that differential in the early years. So you've got extra money sitting around, but now you got a bunch of debt. You're going to pay it down. And it's better for you as selling shareholder, it's better for the company, and it's better for the employees because in those early years, the repurchase obligation is next to zero. In most transactions, it's next to zero. And so the power of that free cash flow to get out from underneath of the debt that's created in the transaction is really what it's for. And then later, as you've heard me say before, that tax freedom is to help the company honor the promise of the ESOP to the employees in their retirement.
Mhm. So having that additional cash flow can allow you to essentially repay the seller faster. And one thing I'll throw out there is when a transaction is seller financed or even if it's split, whatever portion is seller finance, we typically see no penalties for prepayment. So if there is excess cash available, you can pay off the seller faster, even if it's faster than the agreed upon terms of the note. Um, so potentially in a C Corp, the seller is not getting repaid as fast because the company is still paying that income tax. So again, many considerations, and it's not easy to just conceptually discuss it. It's a decision that has to be made with looking at the actual math and the numbers behind it.
And with that, I want to add when we're talking about taxation, you have experience in what your tax liability is today, and that's what you're taking into that's what you're bringing into mind when you're hearing us say double taxation or C corp and the S corp portion. The particular benefit that is unique to ESOPs is because it is a stock plan. There is another tax advantage, whether it's C or S, that's related to that, which is the payment on the inside note. So your contribution into the ESOP that releases the shares, I think Mackenzie's gone over this before in a couple of episodes. That contribution is tax deductible, and it is mostly non-cash, all non-cash in the early years. And so your company still has access to the money because it's a round trip, but it is tax deductible. And so you have a lesser tax liability at the C Corp level and at the S Corp level because of the ESOP benefit. And then your interest on your notes is likely tax deductible. And so if you're thinking, man, we make like $5 million of net income a year, why would I want to pay 26.5% or 21.5% at the C corp level, and then the other portion if I don't have to, or how does this work on the other side? And it's not the same 5 million. It's going to depend on what that contribution is, and then what the amount of the incremental debt is. The interest expense is reduces taxable income, even though that's an actual cash outflow. And these are those things that Mackenzie's talking about. Like, there's so much that you have to look into because it's not the same as it is today, because it will be different with the ESOP specific components of the transaction.
Mhm. So a few strategic considerations I'd like to touch on, and we've kind of mentioned a few that, for example, age can play a part in the decision you're making here. Um, the amount of your current basis can play a part in where your decision lands. the intended percentage that you are selling to the ESOP, for example, you as the seller may know that you, no matter what, want to sell 100%, or no matter what, you want to maintain control. So if that's a concrete decision, then that impacts the options available to you in regards to S Corp or C Corp. One other strategic consideration that I would like to hear your thoughts on, Jason, is how does future growth or acquisitions or raising capital for a business impact whether an S or C Corp status makes more sense?
How much time do we got?
We can expand this one to its own episode as well.
We probably should. And listeners, I know that you've heard me say it before, or I say it so often that I think I've shared it with you because I think most of my life has been shared on this podcast over the last year. So I look at everything through the lens of it's a capital problem, is what I say. Everything's a capital problem, or it's a capital constraint. And you're introducing new constraints with different implications. Are you doing a partial or are you doing a full? Do you need bank financing for an unproductive use of capital? Or do you need to make an acquisition? Do you routinely borrow for fleet purposes or equipment, or are you buying or building new facilities? The arrangement of how you stack your capital and the order over time that you need to have access to that all matters. And it should be included as you evaluate whether or not this is the right time for an ESOP transaction. And I would offer investigate that before deciding, oh, we need to borrow to do this, or we routinely need to borrow to do that. And so I guess as long as we need to borrow, we can never undergo an ESOP transaction. Explore that first, rather than just making the decision that because we need capital, we can't. It's what are the uses of that capital? Is it productive or non-productive? And then who sits where in the stack? And that's to your point, a whole nother discussion that we address pretty head on with clients. And it's not as simple as what's your capex, and then it's really how are you going to achieve your growth plan, and does your growth plan require acquisition? Does it require capex investment? What's the maintenance of your fleet? Under what conditions? If you're projecting 15% growth, what do you need in order to achieve that growth? At what point do you need more people, more facilities, more trucks, or whatever it is that you do, more assembly lines, more CNC equipment? What go into that so that it can be properly built? Because that will affect not just value, but how you structure your debt with current lenders, your debt as a seller, and then that proper mix. And so it's a fun little puzzle for us to help put together for every client. For me, that's probably my favorite, just because of what it could mean, and it doesn't need to be shied away from. You just need to investigate it with gusto, really, because that's the lifeblood of your company, and it's what creates the capital constraint, and it could be more constraining or not as constraining as you thought, but until it's vetted out, you won't know.
Mm-hmm. Really good explanation there. I think we've touched on common misconceptions with ESOPs in terms of tax implications. For example, sometimes the owners become too focused on one tax benefit without considering the bigger picture. Maybe they don't even realize there is a difference in tax implications for whether you are an S Corp or C Corp. This may not be an easy question to answer, but if you had to pick one thing, what is something that you wish every owner understood before making this decision?
Oh, that is not an easy question to answer. Give me a minute. The tax advantages are significant and they are real. They are tangible. They are powerful. They are not the only consideration. And we see very often that it may create a lot of it's a word that I'm looking for, a lot of enthusiasm. And I'm right there with every one of you. I think we've said it pretty plainly here. We get no more satisfaction than keeping more dollars going to Washington and keeping them in the pockets of employees and creating more owners. And all of that is both fun and exciting. And like I said, it's powerful, but all the questions that we went through, especially like the capital planning piece, and then how do you prioritize you personally versus the company and structure. And I wish owners would understand that it's just not one or two dimensional. It's multi-dimensional, and it bears really deep investigation on the personal side and on the business side. I think most of you do, listeners. I'm going to give you credit. I don't want to insult your intelligence by saying, oh, people are just driven by the fact that they don't want to pay taxes. I know you're tired of paying taxes because we hear that too, having to do that. But there are ways to accomplish most, if not all, of your goals in a way that you just got to lean in really deep and go, this is one facet of a complicated transaction. Any transaction you go through is going to be complicated and is going to have tax effects. These are just unique to an ESOP. That's probably a long-winded, windy answer for you, Makenzie.
No, I think that was great. That was perfect. That was really good. I'm glad I stumped you there for a second to think about it. We got him, listeners. We got him. Any last thoughts on S versus C that we missed today that you can think of?
Yeah, one, I don't want to dwell too long on it, but most of you, when you enter into feasibility, are going to have some thoughts about what you want to see, and you're going to say, "This is the transaction that I think I want." Whether it's C or S or seller finance or bank finance, you're like, I need to see if this is going to work out this way. And then we get to this crossroads of we're going to show you what it looks like as a C and what it looks like as an S. And we're going to walk you through all this math. And it's okay for you to change your mind when you see the math, one way or the other. And it has implications. And so if you said, man, we're going to do the 100% S, Uncle Sam's not getting another nickel of the federal income tax from this company ever again. I'm going to seller finance it because I'm already taking the same risk of exchanging my equity for debt. And I believe in this company more than I believe in any other company. And I know it's going to be able to repay me. And this is what I want to do. And then you see the math, or you see the advantage to you, and the impact on the company may be less than you suspected when you see the C Corp, and you go, why don't I do that? Why don't I do the 1042 exchange? And then we go, well, you're going to need some bank financing for that. And you go, what do you mean? And then we'll get to that in our 1042 episode. So it's going to influence how you think and what is available to you. And just know that all those answers are available to you before you have to commit to a decision. Mm-hmm. And that information is going to be, again, one facet of a very complex transaction. Try to shy away from the word complex as much as possible these days. But it's just one facet of the things that you're going to have to investigate. And the answers are available to you. They never have to get shuttled underneath of oh, but just think about how much money's not going to Washington, or just think about how much money you're saving, or just think about don't allow things like that to be buried. Investigate them and get the answer and make a definitive choice.
Yeah, I think that's great advice. Essentially, just having an open mind and not be open to hearing of all your options and try not to get too overwhelmed when you do hear all the options, which is important when choosing your advisor, to have that appropriate advisor that walks you through all the alternatives and options available to you. So I know we've covered quite the list of differences and nuances between S versus C. And as promised, in the next couple of weeks, we will dive more into 1042 because that's just would be too overwhelming to put into this episode as well. And we'd be here all day probably. But we hope you enjoyed this episode. Feel free to share or subscribe, like, and if you enjoyed listening to us, please join us again next week as we will continue to find topics to discuss weekly. So yeah, thank you for joining us.
Thank you.